Actually, we're going to be welcoming the most appropriate person to provide that clarity on just what the new tax protocol with Mauritius will entail. Gokul Chaudhri, leader, direct tax at BMR and Associates, joins us this afternoon on NDTV Profit. So I'm just going to revisit exactly what we're talking about. India has a new tax protocol with Mauritius under which the short-term capital gains tax will apply from now, although there is a grandfathering clause and there is a transition period from April 1, 2017 to March 31st, 2019, where the levy of the short-term capital gains will be at half the prevailing rate. So, Gokul, now that the dust has settled, what are the ambiguities and clarifications that are still needed, according to you?
Well, the tax treaty between India and Mauritius has been a subject matter of controversy for a fair period of time. But we must also recognize that it's the bedrock on which nearly 50% of foreign direct investment from around the world came into India, and subsequently also through Singapore Treaty, which is coterminous with Mauritius. So really, you got a situation here that you had a capital gains tax exemption in Mauritius, and then, of course, you had it in the treaty, which made it a wonderful gateway to India. Now, when we look at the negotiations that took place between India and Mauritius, they've been going on for nearly a decade. What was concerning the government was that they needed to provide a framework which did not upset the investor confidence and the concern that investors have had in the last few years that India has been very unpredictable with its tax policy. So I think the framework that the government has put out in the protocol is very unique. We haven't seen this in any other country around the world, nor has India negotiated similar provisions in any of its treaties. So what has India done firstly? Firstly, it has grandfathered all the existing investments that have been made through Mauritius all the way up to 1st of April 2017, which effectively means that if you are holding investment into India from Mauritius and you made it before the first day of April 2017, you will have the capital gains exemption at the point of time when you exit the shares, whether that be before 2017 or any time thereafter. So in one sense, the entire stock of FDI that sits in India today is secure or feels secure. This uncertainty that the Mauritius Treaty will one day go away and take away the benefit, that uncertainty has gone away. What they have done thereafter is also interesting. They provided, as you correctly said, Manvi, a transition mechanism. This transition mechanism for 2 years allows the short-term capital gains that will get created during this period of time to have a tax rate half of the regular rate in India.
So, Gokul, would you agree if I said that the revised protocol with Mauritius was, by and large, anticipated and hence, net-net, a positive protocol?
Well, people were concerned that one day this treaty will come to an end. And it was not just because of the negotiations, but because India was bringing in a general anti-avoidance rule, GAR, from the 1st of April 2017, which could have been a draconian way to sort of deal with the Mauritius Treaty. There's also concern that India, as a key participant in the G20-led BEPS project, or the Base Erosion and Profit Shifting project, which has within its action steps treaty abuse, would also have to carry out international changes or in its behavior towards tax abusive treaties. So really there was a growing concern that even if the taxman in India was not to be so aggressive, international protocols would have forced us to be able to move forward, specifically because India was going to be a signatory to the forthcoming multilateral instrument, which meant that a number of limitation of benefit tests under the treaties would have got embedded even for the purposes of the Mauritius Treaty. So therefore, I think in 2-3 ways, this protocol has been very helpful. A, it has ended the ambiguity. It's ended the ambiguity by grandfathering the existing investment. It's provided a transition mechanism and has also specified that the limitation of benefit test is only for the benefits that you take during the transition period and not for the legacy investment. To further sweeten the treaty framework, the government has gone ahead and negotiated a certain concessional rate on the debt instruments. What has the government done? Firstly, the government has kept the capital gains exemption still alive for all instruments other than shares, which means debt instruments will continue to have a capital gains exemption. Secondly, they have reduced the withholding rate on interest between India and Mauritius from 20%, which is the domestic rate, down to 7.5%, which makes Mauritius treaty the most attractive among all of India's treaties as far as payout of dividends is concerned. So effectively, an Indian resident paying interest to a Mauritius company will withhold 7.5% from the 1st of April 2017, whereas with the other OECD countries it's 10% withholding, and under the general rule it is 20%. So really, we have enabled Mauritius to be a relevant jurisdiction from a debt perspective.
And that's really important to note, the fact that the exemptions continue on debt instruments. Now let's move to Singapore. When that treaty was signed in 2005, Gokul, one of the covenants was that whatever happens in the Mauritius treaty extends to Singapore. But yesterday, the finance minister, when speaking to the Women's Press Corps, said that, look, Singapore is a separate sovereign state and separate negotiations would have to take place. So how do you interpret, those comments? What do they mean in real terms?
Well, I think the government recognizes that they need to provide a fair, level playing field for investors that came in through Singapore, relying upon the Singapore-India Treaty and relying upon the India-Mauritius Treaty. Insofar as Singapore is concerned, we cannot automatically read in the grandfathering or the transition mechanism into the Singapore Treaty. That will have to be an explicit outcome of a bilateral agreement between India and Singapore. And I think the Indian government is keen that, similar to the fact that they've given a certain outcome for Mauritius, they would probably like to make sure that investors who have come in through Singapore enjoy the same sort of certainty as they have provided for Mauritius. Now, I think that's the intent of the finance minister's decision, but of course bilateral treaties, negotiations are often far wider in their ramifications and far more overarching in what the two countries are trying to achieve. So I think the important part is the finance minister was holding out the conversation to tell investors that we haven't forgotten that there is a Singapore treaty and there's investors from Singapore. I think the finance minister is saying we will reach out and we will try and conclude on giving certainty even to investors under that treaty. What that framework could be may be a little different from Mauritius, but I think the intent seems to be well placed.
The intent, you said, is well placed, and the intent for Singapore would be broadly similar to the intent for Mauritius, wouldn't it?
Well, one would expect so, that the fact that the two treaties were joined at the hip and investors came in relying upon that feature, that outcome should hopefully and sensibly be the same.
Okay, I don't know if it's fair to ask you, Gokul, but I'm still going to. How are clients responding to the Mauritius changes? Your clients at BMR. And in your opinion, are the FDI and the FII flows vulnerable here on because of these changes? I mean, could we see a negative fallout in the months ahead?
I think investors are still absorbing the impact. I think they were quite relieved at one stage that the treaty is not unilaterally doing away with the capital gains incentive, including impacting the legacy investments. So I think there was a relief that the government has been very sensible about that piece of it. The second aspect, which is there is investors which are more strategic investors here for the long term, had reconciled to a large extent that going forward they will not have the benefit of a treaty such as the one which we have with India and Mauritius, and they will probably like to reconcile themselves to a treaty framework more with the OECD nations. And hence, I think that there will be going to be a difference between how portfolio investors behave and how the strategic investors behave. I think the strategic investors are quite relieved with the grandfathering provision and are quite willing to consider that they will be on a level playing field for investments made after April 1, 2017, where they are neutral to the jurisdiction from where they arrive. As far as portfolio investors are concerned, there has been a series of steps which have been done by the government in the last few years to give greater certainty to them. The first and foremost was the classification of whether they are going to be taxed as capital gains or business income, which were a characterization issue which the government settled through a circular a year ago. Thereafter, there was this whole controversy on MAT, or the minimum alternate tax, that had haunted the FI industry, and the government came out and proactively dealt with that situation. And now the government is trying to address the concerns on the transition mechanisms for a period of time, and then of course leading into 2000 onwards, the portfolio investors will have a situation that they no longer have a treaty shelter to go with.
Well, Gokul, I'm going to leave it at that, as always. A comprehensive, assessment of what this really means. A, the Mauritius protocol. B, the implications for a proposed change to the, arrangement with Singapore. Gokul Chaudhri of BMR and Associates, thanks very much for joining us today.
Thank you.
Okay, time for a quick break. We're going to turn our attention back to the markets, and particularly stocks like Strides, Arcolab, Brigade Enterprises, Advani Hotels. All of them post earnings. So what does the scorecard look like, and what is the outlook for the stock price? That and much more coming up.